take us back to risk sentiment right now and how it makes ultimately the context of what it was like back in the Gulf War, you say? We've never had as much pessimism?
Yeah, I mean, in some ways, we've had a very cluster of anomalous signals in this 10% correction. I mean, obviously, this correction has been one of the fastest on record, but I think the unique part of it was the decline in sentiment from, you can look at the AAII measure from, bullish to bearish. You can look at the Google trends in terms of recession sentiment. You can look at a lot of the sentiment indicators, the defensive rotation we've seen, just the rotation into international stocks. All of these signals happen less than 3 and 1% of the time. And in some ways, much of it has been during war, crises, or prior recessions. So without a recessionary event, this is incredibly unique. I think when you look at the signaling perspective and you're willing to take a medium-term time horizon of 6 to 12 months, all of these extreme signals are usually contrarian buy signals for the overall market. But the extreme anomaly this time is that the market isn't really down a lot, as much as we've seen a 10% correction. And even over the last 6 months, you can say it's flat. So to the extent that investors are uniquely concerned about the fact that, hey, we're seeing Google recessionary trends spiking to recessionary levels, to the extent that that has been the case in history, should stocks go down to meet that recessionary sentiment, you actually find the opposite correlation, meaning the less stocks are down when you are at these peak recession sentiment levels, usually that's better signals in terms of a stock market advance in the future. It's almost like the lack of correction in stocks gets it right, or that stocks are potentially looking through something. So I think that there's unique signals in the data that actually do suggest opportunity.
Okay, so if you are willing to take on the abrupt fall or two going forward, are we nearing a bottom? Is that sort of the signal that you're getting from historical context right now?
Yeah, I think when you look at it historically, it doesn't really nail the bottom. In terms of picking bottoms, I think that the signals that I look at from a probability perspective are longer term in nature. So when I look and say you want to look out 6 to 12 months and absorb the volatility, I think that there's opportunities in that. That's less to say that the bottom was yesterday or today or maybe even in 2 months from now. But it is to say that after the correction, I think that it might be too late to be bearish to the extent that you have that year-long time horizon.
And Denise, what we've seen is a real flip around in terms of who's outperformed, healthcare dominating, even a bit of financials, but technology has lagged. Is it now that we start to see people recommit? Have fundamentals changed at the same time as human anxieties and any pessimism across the broader markets?
Yeah, so back to that defensive rotation. The defensive sectors in the market, consumer staples, healthcare, the old telecommunication services, and utilities have outperformed by about 1,100 basis points. That, again, has only happened less than 3% of the time in history, and you usually see a cyclical rotation after that, despite the fact that fundamentals may, in fact, deteriorate, which is to say that, look, a lot of that concern around numbers or around the economy has been somewhat priced in. So I do think that there are opportunities in technology. I think the intriguing part about technology is that we've seen really more multiple compression than we have seen a decline in earnings estimates.
Yeah.
So once you're out of that top quartile, when I look back in history and say, okay, you're out of the top quartile of relative forward PE or even relative trailing PE, and you're now into that muddy middle, you usually have a positive risk reward to the extent that fundamentals continue to improve.
And the positive risk reward dominates in any particular part of technology? Are we still thinking hardware, the picks and shovels are where we reallocate, or does software, which hasn't had so much whiplash, continue to support too?
Yeah, so I think software looks the most intriguing in my data set. So again, we have the data going back to 1962. And once you're into that bottom half of the distribution on any valuation measure, and software is there. So you're getting in, again, cheap relative to usually where software trades. You usually have a positive risk reward. Again, you don't have to necessarily be right on fundamentals because you have above 50-50 odds of outperformance, even if fundamentals tend to deteriorate. This isn't to say that software is set up to outperform right this second, but it is to say that it looks like from a historical context, your downside is limited, and to the extent that you have a call option for future growth, your upside is actually shifting the positive risk reward. So I think that of the three major subsectors, hardware, software, and semiconductors, software looks the most intriguing to me.